Hi everyone, this is Paul Lange from Discipline Trading Strategies, and you're about to hear an hour-long event that was presented live to the free members of Discipline Trading Strategies. This event is called a trading quiz, and I'm going to ask 16 or 17 questions, and everybody had a chance to answer in the live event. You won't be answering live, of course, but I'll be reviewing the answers. The purpose of this is not to try to say you're right, you're wrong, or to trick anybody. The purpose was to bring out key topics that I feel a lot of traders get wrong, and in my experience trading people, I wanted to share some of these concepts with you. If you like these events, check out the free stuff page of DTS and you'll see some more of these. So sit back and enjoy the event. Hi everyone, welcome to tonight. Tonight is going to be called a trading quiz, and this is February 7th at 5 o'clock on Wednesday. First Wednesday of every month, DTS special educational event for everybody. All right, here we go. Here's what we're going to do tonight. A little trading quiz is what you got in your email. You saw all this, so you read all that already. What I'm going to do is I'm going to jump right into it. I'm going to ask some questions that may be about trading in general, psychology, or technical concepts. It's not all technical. It's just some general stuff too. I'm going to put up a poll and ask you a question about a chart or whatever it is. I will show you the results of the poll and I'll explain my answer. And I'll also discuss whether or not I feel it's kind of a 100% trading fact or if it has some of my personal opinion added. Let me give you a big introduction first on some important topics, and about 10 minutes in, I'm going to repeat this just for people that join late because I think it's important to understand kind of what I'm doing here. First of all, as I teach, I've never said that it's like my way is the only way to make money. Some people have accused me that that's not at all what it is. What I am very focused on is that you have to have a way to make money. You won't figure it out just guessing or by trial and error or by osmosis. So you do have to learn what you're doing. And even people who learn from me, we all do different things sort of. You learn how to read a chart and your personal preferences all may vary. So this is not about forcing upon you personal opinions of mine. I'll try and let you know when I have an opinion. Sometimes I have an opinion that I feel is borderline fact, maybe not. I'll let you know, but these are pretty much all facts to me. You may not agree, but that's okay. And I want you to understand the purpose of that. This is not about me trying to catch you or me trying to say, oh, I'm right, you're wrong, or to argue about it, or to have trick questions. That's not the point of it at all. I consider it to be very basic things. But I work with a lot of people, and I find that many struggling traders are struggling because they have the wrong, incorrect, or opposite view of many of these points that I'm bringing out. So yes, of course, if I want to make a point, I can show you a chart that makes that point. And naturally, you could go find a chart that proves it wrong. And you can always do that in trading because it's about odds. But I'm here to tell you that what I'm here to show you is based on getting the odds in your favor through my long experience. And I'm here to tell you that what I'm showing you is correct and accurate. So I want to just preface it with that. It's only with the goal of helping you. Okay, that's all that it is. Whatever stage you're in. Some of you may be seminar program members that can benefit from this. Some of you may be considering it. Some of you may be here just to listen and to go off on your own and do your thing. That's all fine. There's no catch here other than to try and help the best that I can. So I will take some time and explain each of these the best that I can. Naturally, some of the explanations may be so lengthy that I can't even, really get too much into it, just give you the bottom line summary of what it is. Because some of them are more, a couple of the technical ones are kind of advanced technical concepts, so I'll try and do the best I can. Okay, so you have a slide up saying what tonight is about, right? So we're ready to begin. Here we go. Now remember, don't write on the screen. I'll put up a survey for you. So here's going to be the first one. It's an easy one to get us rolling here, especially if you've been around the last couple of weeks. An easy one to start. After a really bad day of trading, you should write the best answer. None may be perfect. Those are your 4 choices. Take the next day off, trade with half risk, do something different, paper trade until you've made money. Don't type on the screen. Here comes the survey. There you go. On the screen, go, A, B, C, D. So I'm going to put the answers here. So here's what I said. We had 2, 5, 15, and 2. So here's what we had. 2, 5, 15, and 2. And I'm not going to belabor this one. We had my last event was about this. You can see it on the free stuff page, talking about how that the truth of it is, whether you're new or experienced, you should do nothing different. Because if you're new, you have a plan that you're following, and you follow whatever that plan says. If you're experienced and you're no longer on a plan, so to speak, you come back the next day swinging full force because you have a bad day once in a while. That was the gist of that. We just had that, and you can view the most recent free stuff page event that's out there right now. All right, so that's an easy one. So we start off easy, so not a big deal. All right, so here's number two. Question two. A good trader should never be on the fence. Every trade should be objectively spelled out so there is never a decision to be made at entry time. There's a trader on the fence. What is the Ben's answer? Is that true or false given those two answers? Don't type on the screen. There's a survey. Survey says, so this is the first really good question, and we can have a little discussion about this one. We have, I'll put you back, so we have 14 and 11. So this is kind of a close call here. So there we are. So we had 14 true and 11 false. This is a tricky one, and I hope any seminar student got this right, because this is something I harp on to some degree. Good traders should never be on the fence. It is false. That is false. I know, like to a newer trader, you think that's the goal. And well, obviously, when traders first come to the market, they're very subjective, and the goal is to become as objective as possible. However, it is impossible to be totally objective. If you were to write a trading plan where there was never a decision to be made at entry time, your trading plan would be 150 pages long, and it still wouldn't cover everything. That's not conceivable. It's not possible. Our job is to narrow things down, to get structure, to get things as precise as we can within reason. And then at some point, we turn that job of the final little nuances over to who? Who do we turn that job over to? If you're in the program and you listen to my trading plan video, you know, we turn it over to the idiot. The idiot does have to have a job. He's there, he's working. And for those of you who don't know what I'm talking about that inner demon inside us that does all the stupid stuff when we're trading. You can't get rid of your idiot, you have to control him, and he's in charge of it. If you think about what I'm saying, it's true. Because if you were to truly try to accomplish the fact of making trading 100% objective, you would not be trading a method, you would be trading a system like software tries to do. And there is no software program that works. There is no purely objective method that works. There is no black box trading that works. So we get it as objective as we can, and those final nuances is the art in trading, and that's what makes us a trader, and that's why you can't get it 100%. If you think about it, there is no other choice. There is no way to make a trading plan that eliminates every possible decision, right? Not every possible decision. Whatever you think you've done, what if the market was up 3 more points? What if it was 30 minutes earlier in the day? What if yesterday's high was 3% further away? You know, all these little nuances come into play in your mind when you're making a decision. So answer is false. I do not think that that is my opinion. I think that is fact. It's proven fact because traders trade. Objectivity 100% does not work. All right. Are we starting to like the format now? Hopefully I'm getting a little better at it here. Topic, general trading again. Question number 3. There's a saying out there that in trading that missed money is better than lost money. This saying, A or B, don't type on the screen. This saying has some meaning, but is usually a bad saying. This is one of the hallmark sayings of any good trader. Here comes the survey. As we're waiting for this one, let me give you some intro comments here. I think this one I have to split as being kind of half fact, kind of half my opinion. I have said this saying. I'm actually not proud of saying this saying because it's something that is more or less said to new people. All right, I feel a little better now. Now I don't feel like I'm talking to a whole bunch of people that hate me because I'm giving some crazy answer. But yeah, the point here is as when you become a good trader, it is not acceptable to look at a good trade and just pass it for no reason. In other words, you have your criteria, whatever it is, right? Here's a trade coming up. You're going to make your decision. Obviously, it's a bad decision to take a trade that didn't meet your requirements, right? That we all know that, obviously, hey, that's terrible, right? But if a trade does meet your requirements and you don't take it, to me, that is just as bad of a sin because now you are not trading. Now you're just being subjective at the last minute. Subjectivity at the last minute, your idiot deciding, hey, obviously, like I said, he has to make some decisions, but in terms of the basic components of the trade, it's just as bad to say, oh, I got to get this trade as it is to say, oh, I'm afraid of taking it. And of course, if you take a trade that doesn't work, you lose what? You lose one risk unit, whatever you risk on the trade. If you miss the trade of the week, you could miss 2, 3, 4, 5, 6 risk units, right? So I think it is just as sinful to miss a good trade as it is to take a bad trade. They're both bad things. Obviously, a lot of people are taught that missed money is better than lost money, so just pass everything. But I don't think that's good teaching at all. You got to know what's good or bad. and you don't miss the good stuff, all right? Topic, general trading. You should always pass on a trade that does not meet your requirements, all right? But there's always that close call. And if you decide to take a trade and play it safe, you could, what is the best answer? A, again, don't type on the screen. Take the trade with a wide stop. B, take the trade with a tight stop. C, take the trade and go for a small target. D, always pass close call trades. There's a little bit of a trick question here. And here comes the survey. That's why it says you have to pick the best answer. This is a tough. Again, the point is, yeah, let me say this again for those of you logged in a bit late. I want to be very clear with the point here. The point here is not to get a trick question out there for me to trick you and say, oh, I'm right, you're wrong. It's none of that. These are topics that I know working with traders are issues, and I want to bring out the issue. And I'm here just to help to discuss the issue. You don't have to buy what I'm saying. I'm just telling you that a lot of traders struggle because they're on the other side of these answers. So that's what it is to me. And well, clearly, okay, so we're done here. I have 7, 12, 2, and 6. So here we were. That's a 12 there, by the way. Now, part of this, I think this answer, I'm going to call it fact, but there may be a little bit of semantics here. The answer that is completely wrong is to take the trade with a tight stop. Unfortunately, most people answered. Now, the only way to trade is to share size things so they all have an equal risk. In other words, if you're going to take a tight stop, it means you're much more likely to stop out and you're going to lose your full amount of money. That's what that means. Now, I know some of you may have taken that as risk less money, and I understand that you don't need to explain because there's no names attached to this, but I don't generally agree with that concept. I occasionally will take something with less shares if I plan on adding to it later. I do that fairly frequently. But if I just think a trade stinks, I'm not going to take half to lose half the shares. If you're going to take your normal risk amount, taking a tight stop is the worst thing you could possibly do, correct? Because if it's a questionable trade, you're now going to cough up a loss for the full amount many times easier than you would have otherwise, right? Yeah. So the right answer to me is to take the trade with a wide stop. Now, some of you may be thinking, well, never take a trade around the fence, but that's a fantasy. I don't care where you draw the line in the sand. You can always be on the fence, right? I don't care. I've had this argument with somebody. I don't care where you are, whatever happens, there's always a trade on. I don't care how perfect your standards are because there's never a 1,000% perfect trade. You can show me the best trade you've ever taken, and I can show you 3 things wrong with it. So there's never a perfect trade. So there's always, and you have to accept this, and I'm not just saying this for semantical purposes, there's a real concept to this. You have to understand there's always going to be a trade around the fence. There always is going to be. You can't help that, and you do have to make a decision. The answer cannot be to always pass close call trades because then I think factually you would never be trading. You would never take anything because any trade could be argued as somewhat of a close call trade. There's something wrong with anything. So wherever you draw your line, there's always going to be a close call. Obviously, take the trade and go with the smallest target, I think, is the most incorrect one of all those. Take the trade with the tight stop, I think, is the most wrong answer if you are, unless you meant to take it with a lower dollar risk. I still don't like that answer, but at least I understand it to some degree. And I do this a lot. That's exactly what I do. It's what I teach, actually, is to start off with a wide stop, especially on something you're less sure of. All right, moving on. Number 5. Boy, are we behind. Holy cow. We need a new moderator here who can work better. You are about to take a trade when you notice the only reasonable target would give you less than a 1-to-1 reward to risk ratio. If you know what that is, just don't answer the question because I can't go backwards that far. You should, of course, follow your plan. And by the way, all these answers, I mean, you can always say to any question I ask you, will follow your plan. That's not an answer. The answer is, what should your plan say? If you're going to answer me, follow your plan, then the next question is, what should your plan say? So you can't circumvent the answer by saying that. So what should your plan guide you to do? Best answer, please. A, take the trade if you feel it's highly likely to hit the target. B, never take a trade that is less than a 2.5. It's supposed to be, it's supposed to be 2.5 to 1, excuse me. So there's no confusion there. 2.5 to 1 risk reward to risk. Never take a trade that is less than a 1-to-1 reward to risk. And take the trade, but go for a bigger target. If you're looking at a trade, it's less than a 1-to-1 reward to risk. Take it. Never take it if it's 2.5 to 1 or less. Never take it if it's 1 to 1 or less. Take the trade, but go for a bigger target. Here we go. Survey says, I'm also going to label this one as being 100% factual because this is math. And you can't argue with math, in my view. So I think this is 100% factual. What I'm hitting on a lot of these are things that I know are frequently taught by inexperienced or just on the internet for something to say. Some of these are theoretical things to put on a piece of paper, but if you really trade and you really do this for a long time for a living, you know some of the answers people say are just gobbledygook because it really doesn't make sense. All right, I am jotting down the answers. From A to D, we have 17, 1, 6, and 3. I agree with all of you. 17, take the trade if you feel there's highly likely at the target. I'll come back to why. Only one of you said 1. A lot said C. And I think all 3 of those last ones are equally incorrect because of the simple question, would you take a 1-to-1 trade if I could prove to you, or historically it was proven, or you truly felt it had an 80% chance of getting there? And the answer to that would be, of course you would, right? You'd have to be only foolish to not do that. So there's not necessarily anything wrong. In my whole program, I don't teach a fixed reward to risk ratio as being necessary because it's not just the reward to risk, it's not just the batting average, it's called expectancy. It's that blend between the two. You can say, hey, I'm only going to go for 2.5 targets, but if you never get there, you're losing money every trade you take. And what's funny is, I know traders who, insist on going for 2.5, and then you look at their Sharpe ratio, which is like after the fact, what you really do, and they end up at 1.1 anyhow. So it's just a fictitious thing. Some people say, oh, here's what we're going for, but here's what I'm going to take. So what matters is what you do with the setups that you have. Is that correct, everybody? Isn't that what matters? It's what you do with the setups that you have. Now, no one is a bigger fan of having a high potential reward to risk setup on the chart. That's what I'm all about, right? To have that setup there. But then I think there's things you should do to water that down to give you a higher batting average and give you a better overall expectancy in making money. To just blindly say you have to have a certain reward to risk, I think is somewhat foolish. Now, there's also, I like very much a high reward to risk trading style. And I'm not against that at all. And you may set up to have that as a trading style, and you may look for those specific really high reward to risk trades, and that's fine, and you can do that as a style. But you can't say it's wrong to take a lower reward to risk trade if it's a very high probability of getting there. It's all about the blend. It's all about the expectancy. By the way, a good follow-up on that is my favorite book for traders to read. It's called, by Van Tharp, it's called Trading Your Way to Financial Freedom. It gets into the math about trading quite a bit. Some people have started that book and they emailed me and said it's so boring they can't finish reading it. And I email them back and say, then stop trading, please, because you'll never make money. All right, trading in general. Question number 6. As a day trader, you've been doing well and are up to a risk amount of $200. Okay, you're being consistent, you're making $200. You're making $200 a day with that risk amount of $200. You want to make $400 a day. The best approach is to, A, keeping risk small is important, so double the number of trades. B, immediately double your risk amount. C, slowly increase your risk amount until it is doubled as long as you're maintaining consistent trading record. And D, hold positions longer to increase your profit. Survey says, it's the only book I recommend to read. I've written 2 books and I don't recommend reading them. I recommend Van Tharp's book. And Douglas is the book to read for some psychology if you want to get some psychology. That's all you need. You don't need to read anything beyond Mark Douglas's first book. All right, let's continue on here. So looks like we have answers I like on this one. 1, 2, 7. Hey, start voting, people. There's a lot of you here. Not everybody's voting. Yeah, there is nothing to talk about here. The 17 of you had it right. Slowly increase your risk until it is doubled. Yeah, doubling your trades is mathematically senseless because you're dipping down lower into the odds, into the gene pool, if you will, and you're not going to be as successful. So if you're taking the best of your trades and you double your number of trades, you're by definition taking lower quality stuff. Mathematical certainty, you're not going to do as good. If you think about it, whatever you do, theoretically today, if you would have risked 10 times as much money in every trade, if you made money today, you would have made 10 times as much money. I don't recommend doing that because you'll freak out, but slowly building into a bigger risk amount is the correct thing to do. You can't hold longer to increase profits because assume you held the proper amount. Nobody said you didn't hold them to the proper target. Maybe every trade you took was held perfectly. We don't know there's more profit there. You can't just hold longer randomly, right? Holding longer may decrease your profits. A book I was saying it's called Trading. It's if you ever forget, Pete, on the DTS website, there's a page called the Other Stuff page, where it talks about my favorite two movies and my favorite book. The favorite book is Trading Your Way to Financial Freedom by Van Tharp. You shouldn't be trading with real money until you read it, and if you think it's too boring to finish, don't even start trading. Let's go on here. Psychological, this one says it is. I wonder what it is. Question number 7. You should, whoever said I'm throwing you softballs, you might as well just go get a cup of coffee or something. You should get your stop to break even as soon as it's in the money, as soon as you have a quarter of an hour profit, when you have been in the trade for 3 bars, or when you have at least 0.5 hour profit. Oh, sorry, got to pull the plug on this one. All right, we'll vote, except instead of D, never. I'm sorry, I can't stop laughing. I wonder what the right answer is. Anybody want to guess? That's right, let's vote. How did I do that? I didn't put the right answer there. Well, this is kind of an obvious one, right? Oh, right, we have some real voting going on, okay. Yeah, I can't add an E because on my survey results I only put A, B, C, D, or I would have added an E. How are some of you answering it incorrectly? Are some of you actually putting something besides D? Well, that's all right. I mean, obviously, that's my answer. You should know my answer. Obviously, you don't agree with me. Again, as we get to this one, I'm going to say that my answer is 100% backed. 0, my personal opinion. I'm surprised. And again, not many of you are voting. Let's get voting. 4-2. I wonder if this is working right. 4-2-2-8. That's all that voted. Getting your stop to break even is something you should never do per those words. Never. This is not, again, my opinion. This is just silliness. Break even is not a part of any management of a trade. If it happens to come out to break even, that's great. There can be advantages to having a trade that is no longer has any risk as you do other trades, but randomly getting to break even is kind of crazy because your break even is not on a chart anywhere, right? You get in some trade, however you got in, and boom, you get in a trade and you put your stop somewhere, but you go green. So you go green as soon as it's in the money, some of you said. As soon as the stock is up 1 penny, you put the stop to 0. And you're out of every trade in 5 seconds with no profit. That's not how you do it. And you can't even characterize it in terms of being up X amount of money because it depends what target you're going for, it depends what chart you have set up. You manage a chart based on the chart. And it is unlikely that the chart would ever find your entry point being the correct exit. It could at some point, but that would be a coincidence. Break even is just a mental crutch for traders because what does break even protect you from? Somebody tell me. Exactly, from being a loser. That's why this is the first psychological one. It's a psychological crutch because if you close green, you feel like you're not a loser, but that doesn't mean you make money. Taking lots of small profits or protecting 0 all the time is how traders go broke all the time. Trust me, you can't do that. You have to go for targets, good targets. When you have the ability to hit good targets, you manage a trade properly based on the chart to get there. Break even is not a part of that discussion whatsoever. Now, if you happen to raise your stop and it coincidentally comes out to be your break even, great. Say you have a free trade. I always use the word free because I don't like the word break even because it implies that's what you're trying to do. Moving on, number 8, technical. Uh-oh, now we're getting technical. They are going to get tougher as we go here. In a proper trending uptrend, the best angle of ascent is 45 degrees, 30 degrees, 60 degrees, between 45 and 60 degrees. Memorize your answer A, B, C, or D because I'm not going to go back. And don't type it on the screen. I'm going to give you the survey. Go. Oh, this is a trick question as it turns out. But somebody, if you would like to do a write-in answer on this one, you may. This is the only one. You may do a write-in answer if you will. I should have taken this test myself. We have 10 saying A. Any write-in answers? 9 saying B, 3 saying C, 5 saying D, and 2/3 of you not voting. Once again, this is not a matter of opinion. This is simply a matter of fact. There is no proper angle. It's ridiculous. It's garbage to try and say there's a right angle. And unfortunately, I should have made D none of the above. I didn't do that. So the right answer is it is none of these. Out of the best of these, there is no best. It's a failed question. I didn't have the right answer there. There is, if you're a platinum member, there's not a prior video, but there was an article written called Test Your Knowledge, kind of similar to what we're doing today. And it discusses this fact, and here's why. If you take the exact same chart, and you have, somebody just showed me their platform, and their charts are all like this, and my charts are all like this. The exact same stock, with the exact same trend, will look like this here, 30 degrees, and look like this here. Is this true, everybody? Is that true or not? The exact same stock, same time frame, same number of bars, right? So it is ridiculous to talk about an angle of ascent when it depends on how you size your chart. Right, John, you got it. And also how wide your bars are, whether or not you include moving averages in the top or bottom, whether or not you include volume or indicators in the top or bottom, all that affects the sizing of your chart. It's ridiculous. There's no such thing as the proper angle of ascent based on the angle of the moving average. What's important is that you size your charts the same all the time, and you get to know the feel of what your charts look like and how they relate to any moving average that you may use. Number 9, never short a stock when you are shorting what is then the high of the day, or same question, we never buy a stock that is what is then the low of the day. What do you think about that comment? A, always follow that rule. It's a hallmark of a great trader. B, it can be done if the stochastic is above 90, way up there, in terms of shorting, like the top question says. It can be done if the price is above the upper Bollinger Band. It can be a great strategy without using stochastics or Bollinger Bands if the other time frames agree. So let's review those again. We're talking about shorting a stock at the high of the day. What do you think about that? Never short a stock. So A says never short a stock at the high of the day. You never do that. That's the hallmark of a great trader. B says, well, you can short a stock at the high of the day if the stochastic is above 90. C says you can short a stock at the high of the day if the upper Bollinger Bands, if you're above the upper Bollinger Band. And D says that you can short at the high of the day without using stochastics or Bollinger Bands if the other time frames agree. Survey says, go ahead. Once again, on this one, I might get some flack on this one, but this is not opinion, this is fact. This is just trading 101. You may maybe call me on, you think it's a little bit of a trick question, but I don't think it is at all. So I have 20022 with a third of you voting. B and D, I'm glad none of you put that because that is never the correct answer. You never make any trading decision or entry based on garbagey indicators that are worthless. That is not the hallmark of a great trader. Shorting at the high of the day is how you make money. How else do you make money? But there's a right and way to wrong. It not only can be, this is a great strategy. I do this every day if the other time frames agree. No, but there is no none of the above. D is correct. This can be a great strategy. The only word to be did is it is a great strategy. And I'll show you what I mean if you're questioning me because somebody told you, oh, never short a strong stock or something like that. Well, here is when you would short the high of the day. Let's say you're a day trader, or you could be, it doesn't matter, this could be a weekly chart long term. And here's your pattern that you're in, right? A great shortable pattern, right? And let's say your day begins right there, right? And it ends here. Oh, I know, you don't see the screen. I knew that. I was just getting the screen ready for you. So when you flipped over, everything's there. So this is a beautiful downtrend to short, right? Beautiful downtrend to short, right? What if the day ended here? So we start the day. Here goes the stock. it's green on the day, it's at the high of the day, and that may be the absolute perfect spot to short it. So this nonsense about don't short a stock that's green on the day, don't short a stock that's at the high of the day, you play patterns, and that pattern may be such you're shorting the high of the day because it makes sense in other time frames. So D is the perfect answer. There can be no argument about that one. How else do you make money if you don't short something near the high of the day? Would you short the low of the day because it's weak at that point? No. You have to just learn how to do it properly. It can be, John. You should know that it can be. Yeah, I've shorted a penny or two off the high of the day, yeah. And I just meant strategically. I mean, but even still, yeah, you actually can short. In the extreme case, you should know that you can short 2 cents off the high of the day if the setup is correct. That's right. Number 10. Let me know if you have questions. We are going to run late. I can't help that. When the 5-minute chart is uptrending, a good day trader should only focus on long and certainly not be shorting. Best answer, true or false? This is going to be, I think, an easy one. A is true, B is false. I'm going to cut it there because I got advanced. I got 6 and 13. This is just another way of saying the same thing. This is another way of asking the same question in a sense, and Mike's going to say it's another softball. Right, but best answer, and that's why it says you should only focus long. No, this could be the same exact thing. In other words, you could have, as a day trader, you could have, because it says 5-minute chart, you could have a big hourly downtrend going on, right? Now, I don't like, James, if extended shorting fits. No, that's not a concept at all. You don't short something that's extended. Never, because extended stocks running up tend to just stay strong and get stronger. So you have to have some strategic concept, and that has to come from the higher time frame, or you have to enter the realm of a climactic situation, which is a very tough concept. Yeah, it's a very tough one to, in my mind, it's a very tough one to hold to. A climactic is not that often. So extended is also a very subjective term. It's not something I use in any strategic concept. It's only a visual term to say, okay, it's getting extended. What does that mean? We liking this? Good stuff? I'm going to keep going. We're going to obviously, the video of this will probably be an hour, and I take out all of my goofs, fluffs, and missteps. Will probably be an hour, but I have 16, I think, so we got a few more to go, 5 more to go. All right, here's a good one. All right, Mike was complaining about softballs. All right, we're getting up there, Mike. We're getting into, maybe, 75-mile-an-hour pitches now. When moving average cross, as in this illustration below, it is, best answer, meaningless, a buy signal, a change in trend, an indication to cover shorts. Take a good look at those. Remember, don't type on the screen. Memorize your answer. When moving averages cross like this, so obviously we have them both heading down. Obviously this is a smaller period moving average because it's changing quicker. It crosses that one right there. When they cross, moving average crossover. Boy, that sounds so cool. Moving average, they should have some indicator that talks about a moving average crossover divergence. Wouldn't that be a cool indicator? I'd use that all the time. So when moving averages cross, meaningless buy signal, change in trend, indication to cover shorts. Correct answer is A, B, C, or D. Go. I'll get you on one of these questions, Mike. Oh, well, good. More you're voting. There we go. Keep them coming. Some of you, if you have a hard time hitting the button, we have a mail-in voting procedure. You can email in your vote, and I'll add it to the tally later. The answers here, we have 20, 1, 5, and 1. And there we go. Very good. This is completely... Do you live in Florida, John? If you live in Florida, you can vote as many times as you want to. This moving average crossovers are meaningless. And I know some of you, if you're newer, you're going to start leaving the room or emailing me about how dumb I am. But moving averages are completely meaningless. They don't mean anything. If you trade moving average crossovers, or somebody taught you to do that, sure you can find patterns where it worked, but it's not going to work for you. There's all kinds of questions, even if you were to tell me it works, is what time frame are you doing it on? What moving average? It's a meaningless concept. It doesn't mean anything. It could show you time and time again where the moving averages could cross, but you continue heading lower. When it does work, it's often such a late entry, I wouldn't even want to do it. It's just, yeah. So moving averages are never, ever to be used in terms of any kind of entry concept ever. Now, don't get me wrong. You guys know me. I'm not a moving average hater. I have moving averages on my chart, but they're there for a very specific purpose. Okay, very specific purpose. And that's just for me to get a good guide on what the trend is. Think back to that 45-degree angle thing. That's not meaningful, but the price compared to the moving average is what's meaningful. All right, good job, good job. Question number 12, I think there's 16, and the last two are easy. Our exponential moving average, boy, good English here. I'll have to fix these slides up if I ever do this again. Our exponential moving average is better than simple moving averages. Always, they're always better. They're better when scalping. They're better when trailing a position. It's like asking if a four-leaf clovers are better good luck charms than horseshoes. Pick your answer. Keep voting. Let me, for some of you logged in late, I just wanted to add, I'm doing this not to trick people. I'm doing this not to say, oh, I'm right, you're wrong. I'm doing this because these bring out key concepts that I think a lot of traders stumble over in the intermediate stages, and a lot of people when they're new have some of these concepts completely wrong. And if you're following some of these things, you're just going to be down a long, stumbly road of failure. So I want to just point them out to you as early as I can. The things I'm telling you are not opinion, they're just fact. They're just the way it is. There is no other discussion about it. At least some of you may have to go through the bumps and grinds of learning some of this, but the shortcut is to just trust what I'm telling you. All right, we have a very strong opinion here on this one, and that is we have 24 saying D, and one person said A. I happen to know who that person that is that said A, and I'm going to point them out and mock them publicly right now. I'm just kidding. I don't know who it is. Exponential, simple, simply doesn't matter. I don't care what you do. I have simple on mine, but the point is that you keep the same moving average on there. You keep your chart size the same way. Use the same bar spacing. And that if you switch from computer to computer or to a laptop, that you take your platform and send it to your other computers. You're using the same charts all the time. So you just get to know the look of what you're looking at, right? Exponential is going to hug tighter. That's not better. I love these people argue, oh, it's better because you're following the price closer. Well, what does that mean? Why is that better? If you want something that follows the price closely, you know what you could look at? Anybody know the answer to that? If you want to use exponential because it follows the price really close, I know something that follows the price even closer than a super fast exponential. You know what that is? It's price. It's price itself, and that's what we look at. So moving averages have a purpose. I don't care what you use. I don't even care what numbers you use, as long as you space them far enough apart that you get some interaction between the moving averages, which gets into a little deeper discussion. All right, we're getting there. You can even, you can leave them off, Pete, as far as I'm concerned. I leave them on because they do serve a purpose for me that I like, but I would not criticize anybody who was trained by me if they want to leave them off. I'm okay with that. I like them on, but I think they're kind of an optional thing. Question 13. You don't have to know the direction of price to take a trade or to make money. This is true or false? Oh no, that's insane. That is sometimes true, but you should never take a trade like that. It's true and trades can be taken. So you got to read that wording there. That's insane. You don't have to know the direction of price to make money. That's insane. That is sometimes true, but you shouldn't take a trade. So even though it's sometimes true, you don't take a trade. It is true, and you can take trades based on that. Survey coming up. You guys are getting good about not typing on the screen. I'm very impressed. There's a survey, A, B, or C. And this will be kind of fun because we were recently talking about a topic which would be very near and dear to this exact quote. Does anybody know what I mean by that? This actually is not my quote. I always thought it was, but I actually must have subconsciously devoured it many, many years ago. Who actually says that? If you look up the top 5 quotes from this person, this is one of them. Yeah, Douglas. This is right out of the Douglas handbook. Yeah. All right, we have. I'm going to close it here. So we have quite a few insane. 6, 3, could happen, but don't do it, and 8. So we're a lot closer on this one. Hey, Mike, is that a softball? Mike's criticizing me for softball questions. That was a pretty tough one there, according to the. So here's what we voted is. Oh, you're there. You're there. Yeah, 683. Absolutely, and this gets down to when I talk about learning to trade, and I talk about the 3-legged stool. There's superior technical analysis. There's the psychology, and there's math and probabilities. And this gets into the math and in my mind, this gets into the math and probabilities things. There's in gap class, there's a gap I teach, which is an either way gap, and yet it's one of my favorite things when it happens. And there's several charts that'll set up. I describe it like you're playing with your kid and you throw a ball up on the roof of your house and you have an A-frame house, right? And it goes real close to the top. You may not know if it's going to the front yard or backyard, but you know it's going to go 20, 30 feet off the house, whatever way it goes. And that's a stupid analogy, but that's what I like to think sometimes. There's times that you were at a birthplace of a move, and it may not even be clear which direction, but it doesn't matter because if you use the right entry concepts, it can help you confirm the direction, and you may not know at the time, and it doesn't necessarily matter. I'm not saying every trade is like that, but it absolutely is a valid way to take trades. And I hope for some of you, if you are a little newer and you're giving some textbook answers and you're hearing me say, no, 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 wrong, 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 I hope you appreciate that a lot of what you learn is just wrong in trading. Hey, Sean left. Mike, some of you have been around for some years and doing okay. True, I'm going to give you a question. True or false? 99% of what you read on the internet is crap. Is that true or false? True or false? Most of what you learn most of what you read on the internet is crap. I mean, you just go reading how to trade or whatever. It's just ridiculous. You read the definition of moving averages and all this stuff. Yeah. So you can take trades even if you're not really sure of the direction. It's not the norm, but you absolutely can do that. I do that several times. There's a gap, what I call gapping to target. And we just did gap class last weekend. Some of you heard me talk about gapping to target. Very specific how I trade it. A specific thing to do, whether it goes higher or lower, but it can go either direction, yes. All right, number 14, we're almost there. Backtesting should be done. Backtesting should be done on any new strategy to see how it has performed over the last 6 months. On the strategies you are currently using to see if they are still effective. Only on the past trades that you've taken to see if improvements can be made under various what-if scenarios. Boy, even I'm confused on this one. Backtesting? Okay, so you should backtest any new strategy to see how it's performed over the last 6 months. You should backtest the strategies you're using, backtest them going back a while to see if they're effective, or only backtest trades. So notice C is different. It's not saying backtest strategies, it's saying backtest trades, actual trades, to see if improvements can be made during various what-if scenarios. This also is not my opinion. This is just simple fact. Once again, however, I will meet with some resistance to this because what I say doesn't sound like it makes sense, but it is true. Come on, let's get up to at least half of you. Answers coming in? Oh, I see. The easy ones you guys all answer. That's why the varied, more difficult ones we don't answer. And by the way, if you are newer and you're kind of stumbling because you don't feel like you got a lot of these right, and some people are, there's a lot of people here that are, you saw the first things, a lot of people have been to more than 25 of these, so they've heard me talk a lot, and at the very least they're aware of what I teach, whether or not you necessarily agree with it. Right, so we have not a lot of voting on this one. 2, 13. So here's another one of these, hard things for people to swallow because, again, it's one of those cool things traders say, oh, I got a strategy and there's software where you can take and plug it in and back test it. You can go back, whatever. What I'm talking about is a purely objective concept where there are software programs, and I know several of them, where you could put in your parameters and go back and say, okay, this event happened 780 times over the last 6 months on a group of stocks with over 2 million shares a day, and it worked, 42% of the time, whatever. That's meaningless. That's complete garbage. Don't waste your time doing that because what do you have to make that work? What do you have to put into the software? What do you have to put in? Right, I know, Mike, you don't do that, right? What do you have to put in? You have to put in a purely objective system, right? You have to put in you have to make every variable, and there's no subjectivity involved. So what you're putting into your backtesting system is not what you're going to be actually doing moving forward. And if you do try and do something where it's that fixed parameters, it's not going to work. So backtesting strategies, like this is one of those, it's just like technical indicators, right? If there was a technical indicator that was so wonderful and it worked, what is it? Tell me what it is. There's hundreds and hundreds of indicators. Which one is it that works? Same thing. If you can backtest strategies and tell me which one works, tell me which one it is. Which strategy is it that just objectively works over history? There's no such thing. What you want to do, and the opposite, the number C is one of the most important things I can ever teach traders. And that is what you want to backtest is looking at the trades you took. Why? because those are the trades that you looked at the objective part of your plan and you blended your subjectivity, right? Because you decided this was a trade. That's what matters. The trades you took, not 800 trades that were on your watch list that met a criteria. Is that true, everybody? Am I making my point clear? All that matters is what you did, which is a blend of the objectivity you set up and the subjectivity in the time of the moment. So you got to go back and test that, because you're now testing your idiot as well. And then you go back and you ask, hey, what if I did all these trades, but what if I changed my entry by What if I changed my management by Well, could I get better results on the last 30 trades I took? That's how you make money. Back testing is meaningless in terms of software programs to test a million back trades. Again, I emphasize to you, I have nothing against anybody. I mean, there's no reason I'm against backtesting other than it doesn't work. I don't have stock in an ETF that shorts backtesting companies. I mean, you know what I mean? I have no horse in this race, whatever the expression is. I don't care. I don't use them because they don't work. It is completely worthless to do that. I think I made my point. 15, technical. Oh yeah, we have like 3 or 4 more to go here. Very technical. Here we go. This stock is about to trade to that arrow at 10 o'clock. So we're going to trade to here. I don't want to say what it is. I'm just going to say we're going to trade to there. Where would you expect this stock to be in a week? So I want you now, what I'm going to do is I'm going to give you the answers. I'm going to blow the chart up for you, okay? So the answer is going to be, I'll come back to the slide, but higher because this is a nice hourly breakout. Higher because it's a nice hourly and daily breakout. Note the daily chart down here. And lower as this should not be considered a breakout. So now take your time here. Well, you don't have the survey up anyhow. So here's a bigger look at the chart. Okay, so we've been sideways, and I would call this major resistance up here. We have multiple points we rebound from, and we're going to trade to here. And from there, it's going, we're going to trade to there. We're going to trade to there. That's going to happen. You can see it's also kind of a daily chart thing across right there. You see in the last 7, 8 days right there, we're going to trade up to there. So back to the last slide now. A is going to be, I'd expect this chart to end up higher because it's a nice hourly breakout. B, higher because it's a nice hourly and daily breakout. And C, lower as this should not be considered a breakout. Survey says, as you're putting your answers in, this is a technical question. This comes down to technical understanding of a chart. I'm going to call this 90% fact and 10% subjective. My answer will be something that I teach 100%. I would teach never to do differently than what my answer is. I got to go 100%. You know, it's 100%. This answer is a 100% answer, and to disagree is just wrong. I forgot I had a daily chart up there too. So I got 1, 5, and boy, the answers are falling off. Well, that's because we're here past 6 o'clock. I told you, nobody wants to be here past 6. The correct answer is 9. This is not a breakout. Now, I use the term breakout as a generic term. 100%, this is not a DTS breakout. In other words, when I put the name DTS in front of it, it means it has specific criteria that are taught in class. This is not a DTS breakout. No way, no how. And anybody took class and thinks that's a DTS breakout, you got to go back to square one because it is not. Even using just generic technical analysis terms, there is no way you should be long over the top of that base. Not on the break of that base. Perhaps sometime later when certain criteria are met. But if you can see that daily chart, and I'll just give you the quick terminology, the daily chart is clearly stage 3 if you have to choose, and you never go long over the top. There's no concept of a breakout period. Well, Pablo, you're going to be learning intently very soon, right? And unfortunately, the real answer is a very long answer. I mean, it's like you really have to, we have a 2-hour wind up into why this is not going to be the case. But it's because of the nature of the daily chart that this is highly likely to be a failure. This is Snap, and you can check it out. Well, a couple days later they had earnings, so kind of, you never would know what the actual answer is. But it does, the point is on that chart, you would never ever go long over the top. And you can short the move above the top. You can short the new high in a situation like that. That's that clear. Well, it's semantics, Pablo. I would never call that a breakout. So you're saying it's a failed breakout. I would say it's an expected failed move higher. It's not a breakout to me. It's not a DTS breakout at all. True, many traders would call it a breakout. That's why a lot of traders have trouble trading, because they call things like that breakouts and they say breakouts fail. So if you want to not call it a DTS breakout, you can call it a failed breakout, understanding that a breakout is what a lot of traders consider to be a breakout. And that's how we make money, because a lot of people go long something like that and it doesn't work. All right. And guess what we have here? Oh, kind of a similar concept. Question number 16. This stock has been stalling at what I would call major resistance. In other words, I would call this major resistance over here. So the last three bars test that area and it dropped the rest of the day. So then here we run up and we test this area, right? And you can see maybe we went a couple pennies above the rest of the area, and then it pulls back after that. I didn't want to show you the chart because it pulls back after that, right? So here's the question on this one. This stock is likely lower because it did not really break this area, right? So in other words, we have all these prior highs in here, and one answer is, okay, after this happened, right, we notice we gapped down to here, and then we ran up to here, and we flirted with this area, and then we did drop a little bit. We did drop in here a little bit in here. So A, this stock is likely lower going forward because it didn't really break this area. I'm talking about, over the next couple of days, what should we expect? B, the stock is higher because it did break the area. Or C, the stock is higher because of the way it got there. And this is the most advanced question I have for you. This is even a moderately advanced question for people who take seminars with me. But it's a fun one. It's one of my funnest charts. A, stock is lower because it didn't break the area. B, the stock is higher because it did break the area. And C, this stock is higher. Oh, you know what? I did blow this one up too. So there's what we're looking at. So you can see we went, just 3-4 cents, 3-4 cents above, whatever that means to you. Should have shown you that first, sorry. All right, and after this we have two quick questions. So we have 5, 1, and 10. If I do this another half hour, I'll have this down. I kind of like the way I asked this question because focusing on whether or not this is a breakout, it didn't close the candle above, however. Well, Mike, I gotta pick a little bone there with you. Closing a candle is an irrelevant concept to me, right? This is a 60-minute chart, Mike. What if it was a 30-minute chart? I bet you one of the candles closed above. If not, what if it was a 26-minute chart or a 42-minute chart or a 30, some candle closed above that area if you go to the right time frame, right? So I don't look at closing of bars as being meaningful at all. But what's interesting is that, if you want to get an argument about whether or not 3 cents is breakout or not, it's really not relevant. That's not the part of the question. C is the correct answer here. This is a fun chart. While this was called major resistance, when we were in here, right, you could call this major support. You can call it whatever you want, but there's a resistance area, there's a support area. When you gap down like this, and you get to here, you know what this is? What's this called when you gap down to here and then you trade up to that top line? What is that called now on this day? No, not in terms of breakout. What do we call this area up here? What do we call that silver line? What do we call that silver line now that we're testing it today? Yeah, excellent. It's called absolutely nothing. It's called absolutely nothing. This is both forming of a great strategy. It's also part of just understanding charts in general to understand why that's absolutely nothing. The best thing I could do quickly is to give you the movie. There's a movie called 300. I haven't seen it since it came out, but the basic premise is 300 soldiers went to attack some area, and they get there and they find that there's 2,000 soldiers there, right? And the 300 soldiers beat the 2,000 soldiers. And then you get to the far side of the property, and there's two guys by a campfire. Because, Pablo, what is resistance? What does resistance mean? When you say there's resistance, what does that mean? Well, it typically means that there's sellers there, right? There's sellers there, right? So when we're inside this pattern, we're bouncing back and forth, there's an expectation because we get to here, there's this expectation we go back and forth all the time. But when you're down here, what happens is all the selling reverts to here. And it's again, this is a really long story to get into, but all the selling goes to there. And this normally is something that should bounce out of this like you were hitting your head on a steel ceiling. When that doesn't work, it means that we have burned through all of these sellers. The sellers, everybody, Think about it. The sellers exist in here, right? Not here. It's like that movie 300. Once the 300 eat through 3,000 people, what's left? There's nothing left. There's nothing left there. Now this one will be interesting because this is today, and I'm actually in this trade as a hold. I took this overnight looking for this to move higher. It pulled back about halfway in here. I got in off the bottom. I'm up 1 R unit holding the whole thing as a swing trade. So we'll see what it does. So I'm talking live here. This is not some fictitious chart. This is something I'm actually doing right now based on this strategy. So we'll see where it goes. Naturally, I didn't need to hold it if it doesn't gap up tomorrow, but I'm pretty confident that it'll have a good move higher from here. So it's a little bit confusing on that one. It's a lot, you have to learn a lot of back information first, but basically there is nobody left there. Yeah, but to use a 500 tick chart, you have to have some strategy, right? To understand, right, what's going to happen next. And voting close, we have 7 and 17. 7 and 17. You are unsure of what kind of move to expect. That is 100% a chart knowledge problem, right? You cannot even say the word psychology to me if you don't even know what you're doing technically, right? Can we all agree with that? If you don't have a clue what you're doing, it's like a baseball player who's never played. Imagine somebody who's never played baseball, not even an athletic person, just sits in an office day. He steps up and they give him a chance to hit a home run in the major leagues with 1 pitch, right? And of course, he doesn't even see the ball go by him. And he says, oh, well, that was bad luck. I didn't have my rabbits. I mean, it's ridiculous. I mean, if you don't have the skill, you can't blame psychology. If you don't know when to get in something, don't tell me you have a psychological problem. If you don't know strategies, if you're unsure of where the target is, how can you blame psychology, right? Let's go to the next one and then I'll continue talking about this. Question 18, last question. This is it, final question. You're in a trade that turns out to be a home run. This sounds familiar. But you make very little because you had a firm target and management concept in place, but a third of the way there, you exited because you started to give back a lot of profit. A, you have a purely psychological problem. B, you have a purely chart knowledge problem. C, you may have a psychological problem, but it may be caused by a technical problem. And this is a tricky one, and I'm going to say there's no wrong answer to this one. I agree a little bit with all of these, and I think most of you are going the way that I intended, 7, 2, 10. This here gets to what psychology is, right? In other words, we're saying here, you knew what you're supposed to do, right? It said you had a firm target in place, you had a management concept in place, but you didn't do it. If you know what you're supposed to do, but you can't do it, that is psychology. But what I always say is there's still an asterisk there. Because I find very rarely is it pure psychology review, because there's still this problem. Maybe you have a target, maybe you have a management plan, but you have no confidence, right? In other words, you have this stuff planned out, but you're still all over the map in terms of having any real concept knowledge of where things are happening. So now you kind of feel you have the right to blame psychology, and you kind of do, because yeah, you knew what you're supposed to do and you couldn't do it. But what is the antidote to psychology, everybody? My final comment, and then we're out of here. A plan is part of it. Chart knowledge is part of it, knowing what you're doing. But it's progressing, starting off with little risk and starting off on a risk progression, building confidence as you go. And that's what you have to do. The antidote to psychology is confidence, which you get from success through very small incremental risk progression in the beginning levels. So confidence is a big deal. So you could come back to me on this one and say, well, yeah, Paul, I or he knew what he was supposed to do and he couldn't do it. You said that's the definition of psychology. And I'd say, yes, you're right, it's psychology. But here's the number one thing to fix psychology. Learn what the hell you're doing. Now, I'm a big believer in psychology, so I'm not here boohooing psychology. And yes, some people get to the level where they really do know what they're doing and they can't do it, and that's a problem. I'm just telling you, 90% of the people that I talk to that say they have a psychological problem, it really is not psychology at that point, because they really don't have the confidence or the skill to be able to say, hey, I know exactly what I want to do and I just can't do it. That can be a problem. It absolutely can be, and I'm big on that, but most people don't reach the level to be able to claim psychology is a problem. Hope you enjoyed tonight. We're done. I have nothing else to add. All right, thanks everybody.